Welcome to Sales Tax and More, your go-to resource for all things state tax related. Now here's your host, Michael Fleming.
Hi, Mike Fleming here, founder of Sales Tax and More, and today's co-host of the Sales Tax and More podcast, where we talk about everybody's favorite topic, which is, of course, sales tax. And today we're going to go over some more questions that have been asked during our webinars. But before we do, let me introduce you to my co-host, Ellie Moffat.
Hey everyone, great to be here. I think we really like this podcast style where we get into the webinar questions that we've gotten. But before we do that today, I will, of course, give our introduction. First and foremost, if you like our podcast, please like and subscribe. It really helps us out. And we are Sales Tax and More. We are a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling any of your state tax or related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We'd love to hear from you. And again, we would love to work with you. All right, Mike. So first question we have here, what type of documentation should a vendor collect from their customers that claim they do not meet the economic nexus for a specific state?
Is this a trick question?
Definitely. This is definitely a trick question.
I thought so. All right. Here's why I think it's a trick question. Number one, we never, ever, under any circumstances, ask our customer if they have nexus in a state or not when deciding to charge them tax or not. We don't say, hey, if you have nexus in this state, I need to charge you tax. And if you don't have nexus in the state, then I don't have to charge you tax. So it's always based upon the seller. Wherever the seller has nexus, they don't have any options. They must either collect the tax or a certificate in lieu of the tax. So we don't care if the customer has nexus or not. Now, where this does play a factor is there are certain states out there, if the purchaser is not registered in a state and not required to be registered in that state, in other words, they don't have nexus, they may be able to use alternative documentation. That's not all states. There are about 10 states where alternative documentation cannot be used. But in the rest of the states, you can use some type of alternative documentation if you don't have nexus. Now, it's not the seller's responsibility. They don't have to put on a detective's hat to verify that the purchaser, whether they have nexus or not. There are criminal penalties and interest in addition to civil penalties and interest for the improper use of a certificate or the avoidance of paying tax. So if you tell someone that you're tax exempt or you don't need to pay the tax, so long as you've accepted what they've given you in good faith, they're generally going to go after the purchaser. And there are those criminal penalties in addition to the civil penalties. Now, there's one exception here. If you yourself have created an economic nexus, for example, say you're selling into the state of Illinois and you've shipped more than 200 items into the state of Illinois, you yourself have created that economic nexus and you should have known that you created the economic nexus. So therefore you cannot accept alternative documentation. State of Illinois, probably a bad example because they don't accept alternative documentation. So let's use the state of New Jersey, which does accept alternative documentation, and they do have a 200 transaction limit or $100,000. Whatever the state's economic thresholds are, if you yourself have shipped that amount into the state, then you've created the nexus, and you should know that. So you should know that you can't accept alternative documentation from that seller. Now, let's say you did 100 transactions or $50,000. It's not your responsibility to play the detective. You don't have to find out if someone else did the other 100 transactions or the other $50,000. That's not up to you. That's on the buyer. They're supposed to keep on track of that, and they can get in trouble for providing you improper documentation. That's why I say this is a trick question here. Very important that you collect tax or certificate in every situation. What type of certificate you collect is going to be up to the borrower to give you. But if they're giving you the wrong, then the state in general is going to go after the buyer rather than the seller, provided everything has been done in good faith.
All right. Thank you so much, Mike. And thanks for, I guess it's good. I guess I expected you to catch this trick question. I guess it's definitely good that it was seen that way from the get-go. So
It was a head scratcher.
it's a little bit of a head scratcher, but I'm glad. Thank you for providing some clarity out there. Next question. And this question comes with quite a bit of context as well. It again is a webinar question. What is the best way to resolve sales tax collected in the wrong states? My client collected sales tax in 27 states last year to the tune of $75,000. States that they are not registered in and do not have economic or physical nexus in. This was due to incorrect settings in QBO. I think that's QuickBooks, correct?
Yes,
And
QuickBooks.
yeah, I'm
QuickBooks Online,
assuming
to be exact.
QuickBooks Online. I am assuming refunding the tax to the customer is the correct approach, but the client feels uneasy about telling his customers he messed up. Could you please weigh in? So a lot of information there. Excuse my mess ups here. And Mike, could you weigh in?
Yeah, absolutely. And number one, I would question the assumption here that in these 27 states, that there is no economic or physical nexus. $75,000 in tax is not a small number. You got to figure the average tax rate out there is somewhere in the neighborhood of 8%. So I can't imagine that there's not an economic nexus in at least some of these states. So that's the first thing you want to do is make sure that you don't have an economic nexus. Because the worst thing that can happen is you give all this money back and then the state comes after you and you had collected the tax and now you got to pay it out of your pocket. So you're just taking a bad situation and have made it worse. So that is the first step. Make sure, have someone double check that you actually don't have any economic nexus or physical nexus. A lot of people don't realize third-party relationships can create nexus for you, inventory can create nexus for you. So you want to make sure you don't have an economic or physical nexus in any of these states. In any of the states where you do have the nexus, you would definitely want to, in my opinion, provided what the exposure is in each one of these states, do a voluntary disclosure agreement. Because when you collect and don't remit tax, there's the potential for criminal penalties and interest in addition to civil penalties and interest. And in a lot of states, they'll waive both the criminal and the civil penalties. Interest in most states, there's about 7 or so states that will waive some or all of the interest. Texas is one of the states that waives all of the interest. Oklahoma waives 50% of the interest. But most states, the majority of states out there, don't waive any interest whatsoever. So in states where you do have nexus, I think that what you want to do is a voluntary disclosure agreement if the exposure is material. If the exposure is not very material, for example, maybe it's only 6 months, then maybe you want to do some historical returns. It's a lot less formal process. You can still ask for penalty waiver and you can go from there. Now, if you don't have Nexus and you don't want to return that money to your customers, most of the states are going to want that money turned into them, plus they're going to want the penalty and interest. It used to be a lot easier to be able to get something to the state on an anonymous basis. It is tough to get that done nowadays. Most of the states are going to want you to register, get that turned in, and then go ahead. And if you truly don't have Nexus, you can deregister after the fact. So again, if your exposure is material and you don't want to give it back to your clients, VDAs are probably the best way to go. The second best way would be to look for, depends on how long this is, but look for any amnesties that are available out there. In general, VDAs are better than amnesties. Under certain circumstances, amnesties are better than VDAs. So you want to look at your VDAs, you want to look at your amnesties, but historical registration is a lot less formal than a voluntary disclosure agreement. So therefore, in a historical registration, you use the actual date that you started collecting the taxes and then are going to want to remit them to the states. You're going to ask for a penalty waiver. Just to let you know what a VDA is, it's a voluntary disclosure agreement. And as a reward for stepping forward voluntarily, the states are going to limit the look back period if you did have nexus. And in most states, they're going to waive the penalty. Sometimes because you've collected the tax, they may waive only a portion of the penalty, but some part of the penalty usually going to get waived. And in most states, you're going to pay the interest also. So was there another part of that question?
There's a lot of parts of this question, but I do think we covered it.
Okay. I was going to say the thing that you don't want to do is keep that money. That's generally referred to as what we call unjust enrichment, which is a nice way of saying the state thinks you're fraud because it's never really the seller's money in most instances. It's either the customer's money or the state's money, and the company is collecting it in trust for the state. So when you keep that money, the state says you unjustly enriched yourself. You needed to either get it back to the customer, you need to get it to us. And if you don't do that, we're coming after you. So worst thing to do is keep that. You got to get it to the state in some way or form or back to the customer.
Exactly. And we talk about that often. That's a huge mistake and something you definitely want to avoid. So
the cardinal sin of sales tax collected, not remitted.
Yes. Okay. Thank you, Mike. So last question on this episode for us. Is it the seller's or purchaser's responsibility to make sure use tax is paid?
What's my favorite answer?
I'm going to go with it depends.
Yes, absolutely. Ding, ding. You got the right answer. As is so often, the answer is going to be it depends. And it depends on a number of factors. In this instance, it's going to depend on the state. So in most states, it's the responsibility of both. So the seller may have a responsibility to collect the tax, but if they don't collect the tax, then it's the buyer's responsibility because just because the seller doesn't collect the tax doesn't mean it's a tax-free transaction. You're supposed to self-assess that tax and remit it to the state directly as a consumer use tax. What can happen if buyers and sellers aren't talking to each other? The tax is only due once, and either the buyer is going to pay it directly as a consumer use tax, or it could be collected as a sales or a use tax from the seller. But if it's not collected when the state comes out, if you're not communicating, it could be collected in both places. So that's why we say when you get audited, you want to contact your vendors and your sellers to make sure that a tax was not paid through someone else's audit, because it's legally only due one time, but it could be the responsibility of both companies, both the purchaser and the seller, to pay that tax. One or the other has to pay it, and if the seller doesn't do it, then the buyer's supposed to do it. And if that's not done, then the state can come after the buyer as well as the purchaser. Now, states don't go after individuals in general. I've seen it happen in very limited instances, but they do go after businesses. So if you're a business, make sure that you are paying your consumer use tax. That is the number one reason for large assessments when you don't have a responsibility for collecting resale certificates. If you have a responsibility for collecting resale certificates, that's the number one cause of large assessments when it comes to an audit. But the number two or number one, depending on your facts and circumstances, is going to be use tax. So if you're the buyer, you got to make sure you're taking care of that. If you're the seller, you cannot contract it away and say, my agreement says that the customer is responsible for it. No, it doesn't work. The state doesn't care about that. You had a responsibility to collect it. The state's going to come after you also. Now, when you get notified of audit, you can send out what we call an XYZ letter. and it asks a series of questions, one of which is going to be, did you self-assess and remit this tax? Another one is going to be, did you pay this through an audit? And if you did, then you got to know the return it was remitted on or know the audit period that it was remitted through. And generally, the state is going to let you off the hook because it only needs to be paid once, but the responsibility can go to both parties. So if you're not talking, it could be collected twice. It's never going to volunteer that it's been paid. They may know it's been paid by one party, but they're never going to volunteer that. They're going to fall back on the old, hey, that's personal information and we're not allowed to share that.
Thank you so much, Mike. If you have questions, please write in for this podcast. If they're complicated, a consultation may be better fit. We have live webinars where you can find some answers as well, and a lot of other free resources on our website. And if you have questions, again, you can reach out to me directly at emoffat, that's EMOFFAT at salestaxandmore.com, or visit our website, salestaxandmore.com. So thank you so much, everyone, for joining us.
Thank you, everyone. We hope that you enjoyed this episode of the Sales Tax and More podcast, and we hope to see you on the next installment of the Sales Tax and More podcast. Bye-bye.
Thanks for listening. Be sure to hit subscribe and check out all the resources we have out on the web.